All right, let's just jump right into this explainer. If you've ever stared at a trading screen and felt completely overwhelmed by all those flashing red and green shapes, believe me, you are not alone. But today we're going to demystify the whole thing. We're actually going to learn how professional traders read price action without relying on guesswork by mastering the market's native language, Japanese candlesticks.
You know, you really can't understand the market's movements until you learn its alphabet. It's just like how you can't read a book without knowing the letters, right? You absolutely cannot interpret what buyers and sellers are doing without understanding candlesticks. It is literally the fundamental language the market uses to communicate its current mood and its future intentions.
So here is our roadmap for today. We'll start with the market's language, break down the anatomy of a candlestick, look at the classic battle of bulls versus bears, decode reversal and continuation patterns, and finally, see what lies beyond the candlestick itself.
Kicking things off with Part 1, the market's language.
A lot of beginners use line and bar charts, but honestly, they are practically useless for real deep analysis. A line chart just zigzags up and down. It might tell you where the price ended, but it totally hides the battle that took place to get there. Japanese candlesticks, on the other hand, are what the pros use. They reveal the entire story, the highs, the lows, the moments of utter panic, and the massive surges of buying power.
So, what actually makes up this alphabet? Let's move into Part 2, anatomy of a candlestick. Let's ground this with the real example. Imagine a stock opens at 10 rupees. It takes a quick dip down to 7, suddenly rockets all the way up to 15, and then finally settles and closes at 13. This raw data is exactly what creates our visual shape. These four crucial data points, the open, the low, the high, and the close, are captured perfectly in every single candlestick, whether you're looking at a fast 1-minute chart or a zoomed-out 1-year chart.
And those exact numbers translate directly into the physical body and the wicks, or shadows as some call them, of the candlestick. The thick, solid block right in the middle, that's the body. It represents the journey purely from the open to the close. The thin lines poking out the top and bottom are the wicks, and they show us the extreme highs and lows that the price reached during that time before snapping back. It's a visual record of the entire tug of war.
Now that we know the parts, let's meet the players in Part 3, bulls versus bears. In the simplest terms, a green candle means a running bullish market. The price closed higher than it opened. Think of a bull charging and thrusting its horns upward. That upward momentum is bullish. Conversely, a red candle means a sleeping, bearish market, where the price fell. A bear swipes down and hibernates. That downward falling price is bearish. It's the ultimate visual shorthand. Green means go, red means drop.
Okay, we have our nouns and verbs. Let's start building some sentences with Part 4, reversal patterns.
A reversal pattern basically means the market was falling, hits a very specific visual formation, and suddenly flips to run upwards, or vice versa. It's the market hitting a brick wall and deciding to turn completely around. Catching these exact pivot moments, that is what traders literally live for.
For example, if you see a downward trend end with a hammer, the market is screaming that the price is about to flip and surge upward. A hammer has a tiny body at the top and a really long wick pointing straight down. I mean, it literally looks like a hammer. It tells us that sellers pushed the price way down, but buyers fiercely rejected that drop and pushed it all the way back up. And here's a crazy fun fact. Whether that hammer candle is green or red doesn't actually matter. The shape alone at the bottom of a downtrend is the signal. The inverted hammer is just that same shape turned upside down, and it means the exact same thing.
Now, when you combine a few candles, you get something like the morning star, a highly reliable bullish reversal pattern. It gets its name because the market has been in the absolute darkness of a downtrend, falling rapidly with a big red candle. Then, a tiny star appears, a moment of hesitation. Finally, the sun rises with a massive green candle that covers more than half of that first red candle.
So I want you to think about this actively for a second. For the morning star to be a valid tradable pattern, does that tiny middle star candle actually need to be green? Like, if you're scanning your charts and you see a red star there, does that ruin the whole setup?
The answer is no. Color totally doesn't matter for that small star. But color absolutely matters here in the bearish engulfing, where a giant red bear totally swallows the green bull. In this setup, the market was happily running upwards, printing green candles. Suddenly, out of nowhere, a massive red candle appears that is so large its body completely covers, or engulfs, the entire previous green candle. The bears have woken up and completely overtaken the bulls. When you see this, expect the price to fall.
And that leads us to the exact opposite of our morning star, the evening star. This tells us the market is getting dark and prices are about to drop. The market is running up strongly, forming a big green candle. It hits a peak, prints a tiny star candle. Then, boom, a massive red candle crashes down, swallowing more than 50% of the original green candle's progress. Night is falling and the bears are taking over.
Here's a quick pop quiz, though. If the market is already plunging downwards, and you suddenly spot this shape, is it an evening star? This is a classic trap that catches so many novice traders who just memorize shapes without actually understanding the context.
The answer is no. An evening star only counts if the market was rising first. A reversal pattern must have something to reverse, right? You can't have an evening star if it's already nighttime. Now, if you want a really clear signal, you look for the soldiers. 3 green soldiers are 3 strong, solid green candles pushing up after a fall. 3 red soldiers are 3 solid red candles crashing down after a rise. The absolute keyword here is solid. These shouldn't be tiny, indecisive candles with long wicks. They need strong, thick bodies showing total market conviction.
Moving right along to Part 5, Continuation Patterns.
Unlike reversals, a continuation pattern means a running trend is merely pausing before it keeps sprinting. If a market is shooting upwards, it literally can't go up in a straight line forever. It has to consolidate and catch its breath. Continuation patterns are those brief moments of rest before the original momentum kicks back in.
When you see a doji or a spinning top, it simply shows market indecision, often acting as a slight pause in an ongoing trend. A doji is practically no body at all. The open and close prices are almost exactly the same, with long wicks sticking out above and below. A spinning top is similar, just with a slightly thicker body. They basically tell us that during this time frame, the bulls pulled the price up, the bears dragged it down, but ultimately the tug of war ended in a tie. It's a moment of pure hesitation.
But you really have to beware of the bullish 3-line strike. This is where impatient traders get completely tricked by 3 red candles, only to get crushed by the massive green continuation. Imagine the market is rising. Suddenly you get 1, 2, 3 small red candles dipping downward. Many amateurs completely panic, thinking it's a massive reversal, and they sell. But then, the very next candle is an absolute monster green candle that swallows all 3 of those small red ones, and the market blasts off higher. Those red candles were just a brief pit stop.
Finally, let's wrap things up with a reality check in Part 6, Beyond the Candlestick.
While you now absolutely speak the market's language, you have to remember that these patterns are not magic guarantees. As our source points out, maybe a specific pattern works 80% of the time and fails 20% of the time. Candlesticks tell you the probability of a move, but you always have to look at the bigger picture, the overall price action, the trading volume, the broader news context. You now have the alphabet, but think about this. If a doji flashes right before a massive corporate earnings call, will you trust the isolated pattern or the whole market story? The real trading begins when you finally learn to read between the lines.